Hello everyone. Today I want to present in my presentation the different difference between private and public financial instruments and how it works in the market. So today we're going to learn about economic factors that may influence the private and public finance gross domestic product and financial instruments and of course stock market. Okay. The world of finance is filled with a variety of instruments for both private and public investors. These instruments range from balance sheet items such as bonds and equities to more complex derivatives such as forwards, futures, and swaps. Each instrument has its own unique features and implications when utilized in certain markets. This article will explore the difference between private and public financial instruments and how they work in the market. Private financial instruments are those where the issuance and transfer of the instrument are generally not regulated. Private instruments are typically used in private deals or transactions, and the terms are typically negotiated between two separate parties, often without the oversight or involvement of the third party. The most common example of private instruments used in financial transactions include private equity, private debt, private placements, private funds, and private investments in real estate. Public financial instruments, on the other hand, are those that are regulated and available to the general public through a sale to the public, such as stock issuing or bond auctions. Public instruments are more regulated than their private counterparts due to the greater potential for investors to assess their potential risk and return. Common public issues include commons, stocks, bonds, initial public offerings, convertible bonds, and interest rate swap agreements. Investment and wealth management is a critical component of healthy financial portfolio. While many individuals may be familiar with the basics of private and public investments, understanding how these different financial instruments work in the market is essential for success. And this article will discuss the different investment options available as well as the advantages and disadvantages of each. And in this presentation, I want to explain and will also provide an overview of how these instruments work in the market and the risks associated with each. Okay, let's go. Private and public financial instruments are instruments that are used by individuals, institutions, and governments for investment or wealth management purpose. Private instruments are investments that are not regulated by the government and are typically issued by the private organizations or individuals. These investments are not available on a public exchange and can range from venture capital investments and hedge funds to private equity investments. Public instruments, on the other hand, are regulated by the government and are traded on public exchanges, such as the New York Stock Exchange, NYSE, or NASDAQ. These instruments can range from shares to government bonds and treasury bills. Public and financial instruments are both ways used by business and other entities to raise money and fund their operations. Depending on the company's specific needs, public and financial instruments can take a variety of forms, such as common stock, bonds, and even private equity. Public and financial instruments are essential to today's economy as they enable business to pursue projects, hire additional employees, and research new products and services. Public and financial instruments are issued by all types of organizations, from publicly traded companies to similar privately held business. Common types of public and financial instruments include common shares, bonds, and private equity, all of which have their own characteristics and purposes. Common stock, also known as equity, is essential ownership in corporation. It typically generates no income but can provide strong capital appreciation. Common stock is usually purchased through a stock exchange like the Nasdaq or the New York Stock Exchange. Bonds are debt instruments that companies and governments use to borrow money. They usually pay a fixed interest rate over the life of the bond, but their value can also fluctuate depending on the borrower's creditworthiness. Private equity is similar to common stock but is generally offered by a single individual or firm, as opposite to being purchased through the exchange. Private equity can provide financial capital to a business as well as certain operational and management advantages. It also typically offers a greater return to the common stock. In addition to these three main types of the public and financial instruments, there are many options to consider depending on the specific needs of the business. Options such as commercial paper, certificates of deposit, and asset-backed securities are all viable avenues for businesses to consider when looking to raise capital. Overall, I want to say that public and financial instruments are essentially for business to pursue new projects, hire employees, and research new products and services. The wide variety of instruments available mean there is likely an option to fit each company's unique needs and goals. Utilizing these instruments correctly can provide businesses with the capital necessary to grow and thrive in today's economy. What are the public and financial instruments? Okay, good question. Public and financial instruments are financial tools that are used to facilitate the exchange of the goods, services, and financial assets. These instruments are essential for the proper functioning of the global economy. They can range from bonds and stocks to derivatives, loans, agreements, and more. Public instruments are created by the government and other public bodies, such as an International Monetary Fund. These instruments may include such items as a foreign exchange rates, central banks, for example, which is located in Washington, and sovereign debt actions. Public instruments have an important role in providing long-term stability to countries and financial markets. By setting and maintaining reasonable and stable prices, they can encourage economic growth. Financial instruments, on the other hand, are created by private companies. These have a range of uses from risk management to financing long-term investments. Stocks, bonds, and derivatives are of examples of financial instruments. Stock represent ownership in a particular company. Bonds are debt securities that provide investors with regular payments. Derivatives are the type of financial contracts whose values are derived from underlying assets. Financial instruments can be divided into two broad categories: primary instruments and secondary instruments. Okay, what is primary instruments? Primary instruments include stocks, bonds, and derivatives. Secondary instruments refer to derivations such as warrants, options, and futures. Financial instruments are essential for investors, companies, and governments to manage their finances and investments. They enable investors to benefit from potential returns on investments, companies to raise capital, and government to manage public funds. Financial instruments are subject to a wide range of regulation and restrictions, including those imposed by central banks, governments, and international organizations. Regulatory bodies ensure that financial instruments meet certain standards of safety, transparency, and fairness. For example, companies issuing stock must provide full disclosure about their financial condition, risk, and prospects. As we all know, the public and financial instruments are an essential part of global economy. These tools make it possible for governments, companies, and investors to exchange goods, services, and financial assets. By providing stability and liquidity to the market, they facilitate economic growth. They are subject to various regulations and restrictions and must meet standards of safety, transparency, and fairness. Thank you very much for your attention.